Hello everybody. So today's video is going to be strictly about gold, and if you are watching gold or if you're holding gold and you want to add to your position, or you exited gold and you want to re-enter gold and you're not sure when the right timing is, today we're going to quickly do a quick analysis of everything there is to know about gold and when you should re-enter. So looking at this graph to start with, you're able to see the correlation between gold and the price of crude oil. Here, this is the one exception, and this is because Trump nominated Kevin Warsh, the Fed chair, and he's an inflation hawk. Real yields also matter a lot when it comes to the gold prices. But as you can see, it rebounded and it retested the higher high. And the only reason it actually started to decline was because the increase of the oil. And this is exactly when the Hormuz got shut. And you can see it's completely directly correlated in terms of pricing. Every time oil spikes, gold dumps, and so forth. This is just to put things into perspective so you can understand how the gold and oil is correlated. And the only time this analog actually broke was right here. So as oil went down, you can see that gold wasn't going up. And the only reason that happened was because we had a jobs report and yields were increasing at the same exact dates. So that's the only reason why it did break. But, we're taking a further dive down into Brent as oil is going down. There's a possibility of a deal being signed, which is exactly why we see the price of gold going up. So who actually owns a lot of the gold right now in the world? There is 36,500 tons, 17% of all of it mined. There is $5 trillion worth of gold right now being held. And this is just an accurate representation for you to see all the different countries and how much they're holding and the last time they've actually purchased gold. So you can kind of get an understanding of what is happening in the world. So as you can see, the US is obviously one of the biggest or the biggest holder by a long shot, but they are not buying. The last time they bought was in 1971. So they're just holding on to their gold. And a lot of these countries haven't really been buying. Russia, the last transaction they had was they actually sold a little bit of their gold in 2026. This is probably because they needed to raise money for the war that's going on with Ukraine and other reasons. China is the only one with Poland that are currently purchasing. Poland is quite weak on the scale, but they are still trying to buy throughout this war that is happening, and they're kind of ignoring what is happening geopolitically. We have Turkey. They actually sold in 2026, and we're going to get more into that later on. But this graph, this pie graph, is a nice, representation for you to understand all the different countries that are holding gold and how much they're holding and why they're holding it and so forth. Moving on, we are looking at the spot price that these countries have paid on average. This is the average price based on every time they've declared they've made a purchase. And then, we backtrack the average price of gold during that time. And then we're able to kind of assume or predict, because these countries are not actually saying, hey guys, we have this much gold. This was our average cost. This is all just based off predictions, based off their own announcements. And that's how we derive what each country's paid for their own gold. The highest one comes at Poland at 2,100 per ounce. We have Turkey at 2,000. We have China at 1,900. We have India at 15. We have Russia at 1,350. So all of them are deep in the money. France is super deep in the money. All these countries are really up on their profits. All of them are, easily 2x. We have 2.1x. We have 3x here. We have more than 3x here. So this is just so you can get an understanding. This would be, like if you ever wanted to know what would be the actual floor of the gold price, well, we would never see prices around their average costs of gold, because what they're going to do is they're going to absolutely gobble it up. So that's just an important representation. I actually was curious about this specific figures, and I pulled it, and I thought other people would probably be curious in the same thing as me. So part B, the biggest seller, the only seller that really mattered during this war was Turkey. This is the graph of Turkish versus the US dollar, and you're able to see how they've been at a steady decline month over month. Now, when the war started with Iran, they actually had no choice but to sell their gold. They had to sell their gold to defend their lira, which, as you can see, it actually did work for a very brief moment. But, the inevitable happens and they continue on the decline as their currency gets weaker and weaker. They sold around 159 tons, which, isn't too much, but they needed to completely raise some funds so they're able to battle this oil shock that we were talking about earlier. So 2026 is actually rhyming with 2013. This is the closest. And I mean, anyone that's looking at this graph, this is 2026. This is 2013's graph. And you're able to really see the resemblance between both of them based off this graph. And here we have at the bottom the real yields. This is the change in the yield. It's not the actual yield price. So as the yields are going up, 2026, we had the yields right now, they just peaked at a 0.29% increase or 0.32. And you can see the gold is going down as this goes up. This is just a very common correlation. Anyone that understands the markets understands this is how the markets work. As the yields go up, we're expecting to see gold going down. Because why would someone purchase gold when they can get paid more from holding the yields? Now, here, as you can see, in 2013, we had the same exact kind of dropping, structure being built, and then we've seen a tiny relief rally. Now, this relief rally right here is also being funded right now. As you can see, we went up around 2.7%, and we could see the rally, keep going, keep rallying into around 4,500, 4,600. That would be the kind of level. And by the way, this level is proportionate directly based on the differences in the falls. So for us to figure out the differences, here we're looking at 75.8%. Here we're looking at 76.9%. These are tiny calculations that someone would do based on, each drop and the differences between them to understand a correlation. And not every single, drop that matches another year is exactly 1-to-1. And that's important to know. So the real yields is the big reason why the gold price is dropping. It could be the war. As you can see, the war did do a decent amount of damage, but the most important thing is the inflation. So we have 4.2% inflation. This is the hottest since 2023, and this was directly correlated with energy being the oil prices going up. So the Fed prices out cuts. So we have the December hike odds at 70%. Goldman stripped all 2026 cuts. When there is rate cuts, what happens is we have a lot more people with cash ready to purchase gold and other things. Real yields jumps above around 2%. The 10%, the 10-year is around 2.16%. All these different things are all playing at the same time. Gold pays you nothing. So the opportunity cost, it goes down. Like there's no reason to purchase gold when you can put your money in a yield and, get a decent return on a yearly basis. And we have the monthly RSI hit 89.7. There's a lot of different things. We were overbought, and then we broke the 50 DMA for selling. We have Turkey and Russia both also selling, which is making everything weaker. This is not one specific thing, but as you can see, it's a lot of different things playing at the same exact time. So that's important to understand that it's not just one specific thing that happens. It's a combination of many different things. So this is the current gold graph right now. And this is important to understand what are the levels that you should be watching when you are deciding whether you should purchase or shouldn't purchase. So at 46.20, we're going to see the 50 DMA. Now, what's going to happen at these levels? This is where I'm predicting the highest of this relief rally that we're in right now is going to get to. I don't believe we're going to be passing the 46.20. The 47.90 is where the 2013 rally rallied up to in proportion. But due to the differences in the rallies, we believe, or I believe, 46.20 is going to be the higher end of this relief rally, and 44 is probably going to be where, we could see some rejection happening. Personally, where am I going to be buying gold? I am waiting for the lower levels, as you can see here at 37.30, 36.16. These are very, very good entries. If you're able to wait until these levels, you're able to really get these entries where you're not stuck in the red for extended periods. If you are already holding gold, well, right now, we're at 4,200. Is it worth selling your gold? I would say probably not if it's actual physical gold, but if you're trading paper gold, then it's always a good time to, wait for that relief rally between the 44 and the 46, exit a little bit of your position and wait for the dip down towards the 37.38. And that is when you can get back in. When you see the 38.94 at 3,900, there is going to be a relief rally when we hit that level. So if you are a short-term trader or a swing trader, you're able to look at 3,900 and get into a little swing trade on that level for a tiny relief rally. So everything is relying on the Hormuz. So if the Hormuz reopens, does the gold reverse? So the oil crashing is, in fact, and gold's friend. As we've seen on the first graph, they're pretty much directly correlated. Now, the thing is, the immediate reaction that people expect is it's going to instantly spike. But that's not completely accurate because there's a lot of people that are buying gold in fear of the war, in fear of World War III, in fear of all these different things, the dollar getting weaker. But as soon as the war is over, a lot of people the people that purchase for that specific reason are going to be selling their gold. Now, that premium is thin, so we're not going to be expecting a huge dump, but we are going to be expecting the first couple days to not look as bullish as you would expect when the war is completed or so-called completed. Now, in the weeks to months after the war, we are expecting, the oil to be falling and actually stabilizing at the lower levels. Pre-premium war, we were at around 68, 65, $70 per barrel. So if we start seeing those levels and it stabilizes around these levels, then we would know that, we're actually getting ready to position into our gold for the long term, basis. So for the weeks and months after, then we can also expect the December hike odds to collapse, and then the real yields will start falling, the dollar softens, and this is the exact reverse of the mechanism that broke gold. And we could definitely be seeing, the exact figures. So we have a very important date on the FOMC, June 16 to June 17. And this date is basically the fundamentals of whether 4,000 is going to hold. Now, what's going to happen on that date is we're going to see the 10-year yield. Now, if it falls back under 2%, if we get towards 1.5%, this is a very bullish trigger, and this should be, what triggers you to enter right away into the gold price. Now, if we see the 10-year yield hold above 2%, we would probably see a close below the 4,000. Now, this is exactly when we're probably going to see that 3,900 level. If you do see that level, then that is good for a swing trade. But if you're more of a long-term trader, then you're probably going to want to hold off a little bit longer if you do see a 2% or higher on the 10-year yield. And the trade is you want to accumulate between 4,000 and 4,150 on hold, size up on the dovish. You stop conviction on a weekly close. So if we have a weekly close that is below 38.94, then you would really want to exit your position so you can average down and get a much lower price on your entry. So this is the gold analysis of what's going to happen. If anybody has any questions, don't hesitate to leave a comment below. And just keep remembering that the oil price is directly correlated, but more importantly, the yields and the jobs and every other factor of the economy also plays a very big role. So just because oil starts dumping doesn't mean instantly to get in, but it means to wait for the FOMC, to watch with the 10-year yield and directly correlate that with gold and understand that that is a very big driver of gold. Thank you guys for watching. Have a great day and stay safe.